So today we're going to cover earned wage access, which seems to be, in my opinion, a repackaging of payday loans. Earned wage access is a new financial instrument which has received a little bit of attention recently. Shout out to the More Perfect Union channel, which is an independent media channel that's recently done an episode about new companies, fintechs, that are allowing employees to access their wages well in advance of the traditional pay cycle. So typically we work, we wait to the end of a 2-week cycle, and then we get a bulk payment, or sometimes a month cycle as well. And wouldn't it be great if we didn't have to wait that whole month to get paid, and we can get paid almost instantly after every day of working? Sounds like something that could be liberating to people who are in a tougher economic situation, or people that simply want to invest or do something creative with their money rather than having it pile up for a month to then get paid. It's been packaged as something that could be potentially liberating for people or a relief, but it seems like when you scratch the surface and look underneath, it's just a payday loan and a quicker way to screw people and create even more razor thin mobility for people who are already struggling for money. So shout out to the More Perfect Union podcast, or sorry, media channel. If you haven't checked it out, please do check them out. I'm also going to add the link to one of their videos that I'm about to share, where they look into kind of the model. Right. So humans are not mathematically driven naturally, which is to say we don't necessarily crunch numbers. There are exceptions to the rule. There are people that are amazing with crunching numbers, calculating interest rates, and really being savvy with the inner mechanics of the way money works. Those people tend to work in finance, are amazing investors like Warren Buffett, Charlie Munger, etc., etc. But most of us are really driven by our emotions. And it just seems like on top of buy now, pay later, 30-year mortgage loans, expensive student loans, leveraging yourself in investments, and also all these other financial instruments, it seems like this is just another way of getting people on the hook so that they're spending money well in advance and find themselves in a difficult position. So here I'm going to share a video where the great people at More Perfect Union are actually crunching the numbers to show exactly how much interest you're paying under this new great product, earned wage access. And I don't know, you can make your conclusions as to whether this is just a repackaging of the traditional Wonga, Amigo loans, all these companies that went down because essentially they were loan sharks. So let's have a look at how this works. Exactly. So we're going to start off with that. I remember when we used to look at payday loans, or I look at just any loan, I just go, oh, what's the interest rate? So I might, if someone offers me, I don't know, £1,000 for a week, and they say, oh, for that £1,000, you pay £50 interest. You go, oh, well, that's not bad. I need the £1,000 now. I'll pay it off, and it's only £50. Not a problem. But that's a one-time transaction. And we always tell ourselves it's a one-time transaction. But once you get into the rhythm of using that type of financing scheme over and over again, you can see how that £50 interest can compound into a very, very scary number.
I know, this equation looks scary, but don't worry, there are online calculators where you just plug in your numbers and they'll do this math for you. APR is like the price of a loan. It takes into account what you'll pay in interest and in fees and the number of days you have to repay.
That's another thing, right? So we go on these apps and immediately we gravitate towards interest. And then we go, oh, it's only a £3 extra fee. We seem to waiver the fee because we think it's just a one-time thing. It's not ongoing, but actually it makes a hell of a difference.
The more time you have to repay the loan, the lower the price of the loan. So let's say you need $100 now. If you took that as a payday loan, that would likely cost you $15 in fees, and it'd be due back in 2 weeks, 14 days. The APR would be 391%.
Imagine, so you're just looking at it and going, oh, it's just £100 and I'm only going to pay him £15 or $15 on top. And that's really where the mathematics stops. Now, again, I could be a fool. Maybe everyone else does the math behind it. Put your comments below and say, look, man, say you're being an absolute tool. You're not telling us anything new. For people like me that aren't the brightest crayons in the box, I just tend to do, oh, look, it's £15 I'm paying to get my £100. No problem. Problem solved. I'll pay that. I'll take the hit. But it's a 191% annual interest rate that you're really paying, which is bananas. If it was packaged that way, you wouldn't even think of it. Or maybe you would, but you'd have to be very, very desperate to do so.
That's expensive. Credit card cash advances usually top out around 36%. So, what if you took that $100 out from Earnin instead?
So Earnin is a popular company that's been invested by billionaires. There's Earnin, there's a Dave app as well. There's this kind of conglomerate of new fintechs that are really, really pumping money into delivering these types of instruments to people that need them. And they're catching a lot of popularity, just like buy now, pay later, which also seems like a fantastic new product. But really, if you look underneath the surface, it was basically the same model as one of these catalogs where you buy stuff and then you pay things in installments, and there's loads of hidden interests and negative impacts to those people who couldn't actually pay off those products that they took out from the catalog. Same mechanisms, just repackaged with technology.
Well, Renita actually did that yesterday, and I asked her to calculate her APR. Her only fee was that small Lightning transfer fee of $3.99. But she's going to get her paycheck tomorrow, and even if she needs the money for something else, Earnin will take back what she owes right away. So she only has 1 day to repay, which means her APR is
1,456.35%.
Imagine. So on these apps, you can take £100 a day in advance, 200. I've looked at the figures here in the UK. There's instruments here in the UK that allows you to take up to half of your salary in one given month. So you're doing it in little lightning shots, and you're going, oh, it doesn't matter, but it compounds, and that's your actual salary. That's the baseline of what you're spending throughout the year. Imagine it's death by 1,000 cuts over several years. And that's assuming that this is the only financial instrument that you're using. Most people that will leverage, that will find this enticing, probably have cash flow problems, and they're pairing that up with other financial instruments like buy now, pay later, like signing up for a 30-year mortgage, like having a student loan debt, which might take £100, £200 a month in repayment fees. All of that compounds and then ends up giving you razor thin mobility, and all that's needed is one incident and the whole thing crashes down. And for me, it seems like we're being treated like stocks. That's all it is. It's like we're doing IOUs towards the future, and then we are completely binded, with absolutely no margin of failure to make sure that we deliver on that. Otherwise, our lives are completely ruined. And I think it's despicable that we continue creating these instruments using the best and brightest minds in the finance world to create these financial instruments, rather than actually just addressing the problem, which is people need better financial education, better job opportunities, and the last thing they need is things like this to bury them even deeper.
Insane. That's a lot. My mind is blown. Jesus Christ.
A study conducted by California regulators found that the average APR for companies like Earnin is 334%. But these calculations don't include all the random hidden charges these apps can have, like subscription fees.
I don't care how small the fee is. They're getting it right back the next day. That should be illegal.
Yes, quadruple-digit interest rates should be illegal, so why aren't they? Well, interest rates are regulated on a state-by-state.
Anyway, why aren't they? Well, we know why they're not. Because it makes lots of people money at the expense of the needy. Very simple. I'm not a communist. I love capitalism. But I do have a massive gripe against people worsening the situation and making capitalism dirtier, rather than actually creating an economy that's flourishing and makes people productive. No, let's not do that. Let's just find ways of turning £1 into £10 of speculative value, and we'll just carry on doing that until our whole economy collapses. For me, that's a vermin trait, and I think it's absolutely Right. So you're probably thinking, oh well, no, this is just an emergency product. People should be responsible, and they should know that these aren't things that you should indulge in or keep as something that's going to be constant in your life to survive, right? It's up to each individual to be responsible. Well, it doesn't really work that way, and we've already got data from the likes of buy now, pay later, which is becoming an increasing problem, and we're seeing that people are slowly relying on this. Because as the global economic position worsens, people start leveraging these tools because they think they can handle it in the long term. It's passing the buck in the future, but you end up paying the price eventually. So let's look at some of the figures here in the UK that really show how this is growing. So according to the Payments Association, the UK's buy now, pay later sector in 2025 stands still as the fastest growing payments types. I wonder why that is. Or is it because it's just amazing? No, it's because people don't have the money to pay for things, and they still want to consume. They still want to buy their kids, those trainers, or they want to look good, and they just lean on this because why not? It's only 3 payments. It's all right. It's temporary debt, and it's now forecasted. The transaction values are forecasted to hit 27.1 billion this year, which is absolutely crazy. Now, again, you could say, oh, no, that's just the wealthy. That's just people that have money. They're responsible. Absolutely no problem. Well, let's look at the FCA data to see whether that's truly the case. Let's look at the split of the type of people that are actually going for these products to see whether this 27.1 billion pounds of transactions, what the spread is, and what the demographics are of people that are actually taking out these. They're not loans or credit. It's not really credit because credit has to be long term. This is short term credit, but let's be honest, it is what it is. You're borrowing money. So the FCA data. So recently, what we're trying to see is what we've seen. Sorry, is most unregulated buy now pay later users used it relatively infrequent, apparently, but frequency of use is increasing. For example, in the 12 months of May 2024, 1.9 million adults, which is 17% of all users, used buy now pay later frequently. So this is 10 or more times in this period. And then up to 1.2 million, which is 14% in 2022. So imagine that. Look how much that's grown. And in May, 2% of UK adults, this is 2024, which is 1.1 million, had £500 or more outstanding debt on this buy now, pay later scheme. 11% of adults had £50 or more outstanding, and 86% of the adults had no debt whatsoever, right? So we're now looking at that 2% and that 11%, which are really worrying. But, you may say, oh, well, 2% is nothing. I mean, 86% of people had no outstanding debt and they're still paying it off and everything's hunky-dory. But 2% of the UK, of UK users of this product is a lot. And that's assuming that they are only using a buy now, pay later scheme. And that's not paired up with the other poisons that we've mentioned. Now, you've heard me talk about 30-year mortgages like it's poison. I completely believe that 30-year mortgages have a place in the nation. But the concerning thing is just how many people are actually opting for the 30-year mortgage versus the traditional 20, 25, or the great 15-year mortgage. If you look at the numbers, so here we've got the this blog by the Bank Underground. Don't worry, I'll find a better source straight after this. But there's a chart that they've actually found from the FCA product sales database where it says what the share of mortgages by term length is, right? So this graph represents how that growth is actually happening. And if we look, the ones that are less than 25 years were really high in 2005. Then we start progressing towards 2009. It starts going down, and in 2023, we're now looking at 30% of the mortgages being 25 years. We're looking at a 20% being 25 years. Now it's the 30-year mortgage term has grown much more to about 20% as well, and then everything higher as well. So there's now a more even distribution of the different categories of loans that people are taking out. Why must that be? It's because they don't have the cash flow. So look, why have we seen this increase in mortgage terms? Rising interest rates, increased cost of living, and higher house prices have all contributed to make mortgages less affordable. Therefore, households have been looking for ways to adjust their mortgages. And what's the problem? What's the problem? You know, okay, it's a 30-year mortgage. It's much more affordable. You know, perhaps rather than paying 1,000 a month on a 200 grand mortgage over a 20-year period, perhaps that's too high, and maybe it's much better to pay £900 over a 30-year mortgage for the same £200,000 house. Absolutely no problem. Well, now you're stuck in debt later. And this article that I'm about to show really explains what the negative consequences are of having a 30-year mortgage. Now, again, the problem is not having a 30-year mortgage. The problem is having several of these financial instruments that push the can down the road that end up compounding and ruining the feasibility of you having a financially healthy household. So here we've got an article by the Homeowners Alliance. And I'm just going to skip straight into the pros and cons of having a 30-year mortgage. So, like I was explaining before, lower monthly repayments. Spreading your mortgage debt over a longer repayment term means your monthly costs will be lower. It's better affordability. When you apply for a mortgage, the lender will assess if you can afford the repayments. As a 30-year mortgage has a lower monthly repayments, you're more likely to pass the affordability test. Fantastic. So this gets you onto the home ownership ladder with a lower threshold. No problem. However, these are the disadvantages. They're more expensive in the long term, as you'll be paying interest for several years longer and will end up paying sustainably more interest with a 30-year mortgage. You're slower to build equity. So imagine when you're on a 15-year mortgage or a 20-year mortgage, those first 5 years, you're actually paying down on the equity. You're gaining equity in your property. Not so much with a 30-year mortgage. In those first 3 or 4 years, you're paying nothing but interest, which means that when you renew your mortgage, you don't actually have much equity. You haven't made much progress. Pretty much the same as renting for the first 4 or 5 years. The only thing you've done is lock in the price of your property. Fair enough. It could be that your property increases in value and you're a winner, and that's where your equity comes from. But what if it doesn't? What if there's a housing crash? There's too many what ifs, and that's where the risk comes from. So look, here we go. You're slower to build equity. As you're paying off less capital each month, you won't build up equity as quickly as the shorter mortgage term. This will affect your ability to get the best interest rates when you remortgage. So you're only going to pay the price further down the line. And God forbid, mortgage rates go up. And also you have debt later in life. If you're landing your mortgage at age 30, that's it. You're paying it off when you're 65. You're still paying it off when you're 65. Or 60. And again, God forbid that you have to have a renovation or you have to remortgage for whatever reason, you're going to be screwed. So maybe you can handle this one financial instrument as risk, but pairing it up with other things, not so much. So if you're using the likes of buy now, pay later, the likes of earn wage access paired with a 30-year mortgage, and then maybe you're doing a bit of investing on the likes of a Robinhood app. Maybe you start becoming enticed by the gambling mechanisms. I'll put £5,000 in my Robinhood, and then Robinhood will allow me to invest another £5,000 on top as an IOU. I might do that. Then I've also got a student loan. Maybe the student loan is £30,000 a year that I took out. So you might have a total of 90k in student loans. 30-year mortgage, leveraging yourself in investment platforms, a bit of buy now, pay later, because why not? It's only £150 spread over 3 weeks or whatever, or £500, whatever it may be. And then on top of that, you do a bit of earn wage access. All of that, it doesn't matter if you're on 100,000 a year, 150,000 a year. If you have rubbish cash flow management, you're only going to over leverage yourself, and you're going to find yourself in a position eventually where that risk compounds and you'll have nothing. And that's in a really, really strong earning potential. Now imagine if you're in a situation where you're truly using this to feed your kids or to just get through the month. I just think it's absolutely despicable. And I really, really hope that eventually something happens to make these financial instruments crash and they're banned. Just like the likes of Amigo Loan or Wonga, all these companies, they ended up failing. These are not the successful financial instruments that our society needs. And that's my personal opinion. Perhaps I'm wrong. If you have a different opinion and you really think that this is the way that that's going to take our society forward, please let me know. Everything that I've said is absolute opinion. Perhaps I've misinterpreted the data. I'm also open to that. But on the surface of it, this looks like something that's only going to add pressure to an already exploding bomb, and it's going to hurt a lot of people. Let me know what you think, or give me a like if you agree or disagree, and I hope to see you next time. Bye.